Introduction. Welcome, investors, to another exciting episode where we explore the world of wealth creation through dividend growth. In today's video, we're going to dissect 7 stocks that have recently increased their dividend payouts, examining their performance, trends, and what these changes mean for investors. I'm your host name, and let's dive into the fascinating realm of dividend growth investing. Before we jump into the analysis, let's quickly recap why dividend growth is crucial for investors. Dividend growth stocks act as a powerful engine, propelling the snowball effect of wealth accumulation. As companies consistently increase their payouts, investors not only enjoy regular income but also benefit from the compounding effect over time. Now, let's meet our lineup of dividend growth stars. Broadcom, AVGO. Host, our first contender, Broadcom, recently saw a substantial 14.1% increase in its dividend, raising it to an impressive $525 per share. This tech giant has shown stellar performance, boasting an 86.47% increase in the past year. What's intriguing is the combination of share price appreciation and remarkable dividend growth, making Broadcom a favorite among dividend growth investors. Using Seeking Alpha, we can delve into various metrics. The company's starting dividend yield is 1.95%, but a deeper dive into my custom dividend dashboard reveals a yield on cost of 4.04%. This not only reflects the value at which I acquired of Go shares but also underscores the significance of dividend growth in boosting overall returns. Let's now turn our attention to the valuation. Plugging in of Go into my stock valuation spreadsheet, we observe a payout ratio of 55.79%. Moving on to the dividend discount model. The projected 7% dividend growth rate and a discount rate of 9% yield a fair value close to the current trading price, suggesting a reasonable valuation. MasterCard, MA. Host. Now, let's shift our focus to MasterCard, a company that not only increased its dividend by 15.88%, but also announced a massive $11 billion stock buyback. While the stock is down 1.34% year to date, the financial prowess of MasterCard extends beyond its share price. Here's why. MasterCard's dividend growth history is a marvel. Over the past decade, it has exhibited a 3-year growth rate of 133%, a 5-year growth rate of 177%, and a 10-year growth rate of 23.38%. Such consistent and robust growth sets the stage for sustained dividend income for investors. Examining the cash flow payout ratio on Seeking Alpha, we find that only around 20% of MasterCard's free cash flow is utilized for dividend payments. This highlights the company's ability to fuel future growth while maintaining its commitment to shareholders. Transitioning to valuation, plugging in MA into my stock valuation spreadsheet and using the dividend discount model, we project a fair value significantly above the current trading price. This implies that, despite short-term fluctuations, the long-term potential of MasterCard remains robust. We'll take a quick break here, but stay tuned as we continue our exploration of dividend growth stocks, including enterprise products partners, waste management, Realty Income, Pfizer, and Deere & Company. Each of these stocks brings its unique dynamics to the table, and we'll uncover the intricacies that make them compelling choices for dividend growth investors. Don't go anywhere. Welcome back, investors. We're continuing our journey through the world of dividend growth stocks. Next on our list is Enterprise Products Partners, a high-yielding stock that recently announced a 3% dividend hike. How does it stack up in terms of sustainability and valuation? With a starting yield of 7.69%, Enterprise Products Partners has a commendable track record of 25 consecutive years of dividend increases. However, a closer look at the dividend growth rates, particularly the 3-year and 5-year figures, reveals a more conservative pattern compared to our earlier contenders. Turning our attention to the cash flow payout ratio on Seeking Alpha, we notice that EPD pays out a significant portion of its free cash flow as dividends. While this is common for high-yield stocks, investors should be mindful of the potential impact on capital appreciation. Entering EPD into my valuation spreadsheet, we observe that analysts currently have a target price slightly below the current trading range. However, utilizing the dividend discount model, we project a fair value that aligns closely with the target, indicating a reasonable valuation. Moving on to our next dividend growth star, Waste Management, which recently announced a 7.1% dividend hike along with a substantial $1.50 billion stock buyback in 2024. Stay with us as we unravel the layers of this waste management giant's dividend story. Waste Management, with its starting dividend yield of 1.57%, might not be the highest yielder, but its consistent dividend growth and impressive stock buyback program make it an intriguing choice for investors seeking reliability and potential for capital appreciation. What sets Waste Management apart is its steady and predictable free cash flow growth. The cash flow payout ratio, standing at 26% for the trailing 12 months, signifies a healthy balance between rewarding shareholders and reinvesting in the business. Entering WM into my valuation spreadsheet, we find that analysts currently have a target price above the current trading range. Using the dividend discount model, the projected 7% dividend growth rate aligns with the historical performance, resulting in a fair value above the current trading price. Our journey through dividend growth stocks continues. And next up is Realty Income, a monthly paying real estate investment trust, REIT, that recently announced a 2% increase in its dividend. Stay tuned as we explore the unique characteristics of this monthly dividend giant. Realty Income, often dubbed the monthly dividend company, is a favorite among income investors. While a 2% quarterly increase may seem modest, it's essential to consider Realty Income's consistent monthly dividend payments, contributing to its appeal. As a REIT, Realty Income's payout ratio is better evaluated using the adjusted